Hi, I'm Scott Robinson, Director of the REIT Center at NYU's SPS Schack Institute of Real Estate. I am fortunate to be co-hosting the 7-part REIT leadership series with my friend and industry colleague, Robin Panovka. Robin co-chairs Wachtell Lipton's real estate and REIT M&A practice with Adam Emmerich, both of whom have long supported the Schack Institute of Real Estate, notably as conference co-chairs of our annual REIT symposium held every spring in New York City. For more than 50 years, the Schack Institute has been at the forefront of real estate education, guiding over 700 matriculated students annually through numerous non-credit and degree programs, including a Bachelor of Science in Real Estate, Real Estate, MS Development, and MS Construction Management. This REIT leadership series was designed to bring our students and numerous stakeholders into a direct conversation with some of the folks shaping our industry today, including Jay Brown of Crown Castle International, Tom Bartlett of American Tower, Aaron Block of MetaProp, Eric Bolton, Mid-America Apartment Communities, Stuart Tanz, Retail Opportunity Investments, Tammy Jones, Basis Investment Group, and Mike Landy, former CEO of Monmouth Real Estate Investment Corp. Importantly, I want to thank the many NYU Schack students who participated in this series and leaned in to prepare accompanying research around the conversations, including Ivan Chen, Emma Denhausen-Braun, Sam Penny, Jacob Bernstein, Ross Hewitt, and Cameron Spiller. Thank you. The topics of conversation among the CEOs in this leadership series are generally focused on each individual company's strategy, but I hope you'll see that they can also be categorized into major themes such as digital infrastructure, leadership, M&A, and specific industry trends. I hope you find these conversations and the related research memos informative, and I look forward to exploring these topics with you further on social media in the coming months. Aaron, it's great to have you today. Appreciate your time. Look, MetaProp, you co-founded MetaProp about 7 years ago. You've invested in, I think well over 135 tech companies. You guys have a global footprint, which I'm not quite sure how you manage that since you're more of a boutique nature firm. But you are one of the old guards, I think, in the real estate prop tech VC space. So before we kind of get into a little more back and forth, why don't you set the stage for us, if you don't mind, sharing the firm's strategy and values and kind of how you guys originally launched the firm back in 2015.
Yeah, thanks, Scott. And thanks for having us, and very happy to be a part of all that you do and the great community and educational support that you and Adam and team put on. So welcome, everyone. I'm Aaron. As Scott mentioned, firm is called MetaProp, and we do one thing, and we try and do it really well. As Scott said, it's a particular niche, and that's real estate technology investing. The category is prop tech. Our particular corner of the universe that we're known for excellence is the kind of tip of the spear, the cutting edge, let's call it tomorrow's technologies. If you're a venture capitalist, you'd probably call it seed investing. That's our sweet spot. It's something we've been doing for a long time. As Scott mentioned, we've got 175 plus now positions, individual companies that we've invested in over the last 10 plus years as a team. We've got 4 funds, about to close our 5th fund, which is great. These early stage real estate technologies, that's a pretty tight buy box for those of you that are in the real estate acquisitions world, for example. That's a pretty specific area of focus. Within that world, we invest across the real estate value chain. So if you think of the life of an asset, a physical asset, from dirt all the way to the disposition of that asset, there are various functions that a real estate practitioner might be involved with, or that a consumer or user would interact with. We invest in technologies that are either disrupting entirely that category or supporting the digitization and transformation of that category within the prop tech space. We do most of our investing in North America, vast majority, although we have some pretty high profile investments more recently in Asia, Europe. We did a couple in West Africa last year, which is pretty exciting, and LATAM. We're a team of 12, so we're a relatively small investment manager by private equity standards, but by venture standards for seed fund, we're a nice team. The one other interesting part of what we do, and a big part of our value proposition to the ecosystem, is it's not just us investing our own capital, it's also the capital of of financial investors, limited partners in our funds, many of whom are financially motivated and like, DPI and cash on cash returns and wonderful IRRs, but also a big portion of the real estate community globally. So those are, pension advisors, real estate private equity, owner developers, asset managers, all the big brokerage firms in the world, Asia, Europe, North America, LATAM, based. Those folks own and manage 20 billion square feet around the world. So we're constantly in conversation with these folks about what's changing in their businesses, what are they seeing, what are their clients seeing, what are their end users seeing, what are their vendors seeing, which helps inform us to be better investors. And in turn, we're bringing our 250 plus opportunities that we review a month back to that group and helping make sure that they can pilot and test and scale up and co-invest in things that are interesting to them. So it's a pretty specific mousetrap, but one that we've really enjoyed building over the last several years.
Yep, I appreciate that. And you guys have done a great job. Looking back, on the one hand, 2015 wasn't that long ago, but over the past 20 months, I think, 3 years ago, seems like it was 20 years ago. But looking back from the 2015 vantage point, how does today's landscape for prop tech and construction tech, whatever the right phraseology might be, how does it look compared to, what you thought you would be seeing back in 2015 as you look forward?
Yeah. So I think all things considered, if you think about what's happened in the world, it's remarkably good, Scott. Things, it's almost like watching a flower blossom in front of your eyes, this prop tech space, albeit building from a very low base. It was a tiny seedling, right, that germinated here. When we started the business, there was something like 700 million invested in the category through venture capital. While now we're talking 20 billion plus per year of venture capital investments. There was only early stage investing in those early years. Now there's a variety of investing, early stage, kind of mid stage, A and B, later stage, pre-IPO, and public markets. Believe it or not, the public markets have been open. That's a change. They're not open the second, but they were for de-SPACing and direct listings over the last couple of years. That's a remarkable maturation of the space. The number of startups in general, we used to say 1,200 to 1,400 when we started. Now folks are saying 7,000 plus. Deal flow has moved from 40 a month to 250 a month. So that's pretty nice growth. And there's some institutional investment managers like us out there who are really professionals at deploying capital into tomorrow's technologies. All great. Most importantly, you're seeing real traction in the market. It's not just investing in startups and seeing what I would call, and you would probably call, the equivalent of cap rate compression, right? Valuation inflation in our world is cap rate compression in the real estate world. That's not what's driving the value. The core value here is that these technologies are actually making a difference. They're gaining traction. They're getting subscriptions. They're getting sales. They're growing their businesses, in meaningful ways. And that's all, if you put all of that together, it's really a remarkable blossoming of this space. And that would be the story I would tell you, Scott, up until 3 or 4 months ago.
Things have changed past 3 or 4 months.
Right on cue, right? Beastly animal. Obviously, it's been a bloodbath in the public markets, and tech has not been spared. The investing that has pulled back in tech and in the public markets has also affected the publicly traded real estate companies by and large. The SPAC market was hot for prop tech. It's now, SPAC market is closed and everybody's hunting for a prop tech de-SPAC and struggling by and large. So that has ramifications. That comes down into the later stages in the pre-IPO deals. What you would expect as an investor is you would expect what we call down rounds, valuations, funding that is dilutive substantially to the entrepreneurs, but potentially more impactfully into their earlier investors. And then from that, if you peel the onion one layer back from that damage, you're probably going to see round extensions, right? So previous valuation rounds getting larger, meaning more dilution, but not as painful and punitive. And then if you peel that back from there, you're seeing, startups that would have normally raised capital, not raising capital because the markets are a little uncertain. And if you peel back from there, you could get to the point where innovation starts to slow down. You're not seeing as many new starts of technology entrepreneurs. Fortunately, a lot of that story isn't happening, but certainly that later stage uncertainty has created, at least at the pre-IPO stage, the beginnings of what could play out in that direction, or could just be a temporary swing of the pendulum. So it's something we watch very carefully, communicate clearly around. That's the difference. Good news is, rounds are getting done. The best companies are getting funded. Our companies are getting funded. All the VCs in the world are spending a lot of time with their portfolio companies, making sure they're managing their, cash to get out, 18, 24 months. So in case this becomes some China, Taiwan thing, in addition to a Russia, Ukraine thing, or whatever other disruption happens, we're in a better place. So I would say by and large, it could be a heck of a lot worse given the circumstances, and it may get a lot worse, but right now things are still pretty much okay.
Good to hear. So look, let's jump back to we'll call it just before COVID. I think there was a lot more interest and adoption of technology, interest in investing in and bringing it into properties. Obviously, that's accelerated with COVID. We can kind of get to that, or we can kind of avoid it altogether since everybody keeps talking about it. But real estate historically has always seemed to be very slow to evolve and adopt new ways of doing business, adopting new technologies. Was there an event, or was there a shift in thinking by property owners to start bringing tech in, back in 17, 18, 19?
Yeah. So, I mean, let's just put it this way. It's about time, Scott, right? And I have been paying attention to this space for a long, long time. It's really nice to see the North American industry get the joke. I think the CEOs used to go to Davos and hear that you have to do tech and digital transformation in the real estate space, and they come back and start pounding the table. And the only people who would listen would be the kind of millennials or Gen Zers now who are coming in and are very tech oriented. I think that's changed quite a bit over the last several years inside of these real estate enterprises in North America. Number one, because there's so much more innovation and the public markets are open, right? And venture capital, right? There's capital flowing into the space, which legitimizes it a little bit. Number two, there's been some watershed kind of storylines. I would say one big one for New York centric approach is Blackstone's strategic investment in BTS several years ago. I think that was a real eye opener to a lot of folks in the space, saying, what's interesting there. Now you have Cushman doing a deal with WeWork and CBRE doing a deal with Industrious and GLO buying Building Engine, right? You see this wave of activity. Altus buying Reonomy. I can go on and on and on for months here, fortunately, because that's one of the signs of health in the space. So that's another thing. And the third thing is, I think a lot of the North American enterprises, the real estate CEOs, and executives, their peers in Asia and Europe have been clamoring for this for a long time, and the world is getting smaller. And the more time you spend with those folks, the more you realize they don't have access to the same level of innovation domestically that we have in this market. And I think that seeing them take the lead and create corporate venture arms and sandboxes to pilot and test and new technologies and focus on ESG was really a leading indicator of what we're seeing here. So I think a combination of all those factors, plus the fact that no millennial or Gen Zer wants to work in an organization that's tech backwards, makes it a real long-term recruiting and retention problem. If you put all those factors together, the last several years have led to this increase in interest.
Yep, no, that makes sense. And I'm definitely seeing that among my students as well. Look, I would say, around the halls here at NYU, my faculty, we typically talk about the life cycle of a company. I like how you mentioned that MetaProp invests in the life cycle of an asset from the dirt to disposition. But I think you and Zach were quoted earlier this year as saying you anticipated a wave of consolidation, M&As in the sector in 2022 and maybe beyond. In a traditional firm setting, I would see M&A activity kind of late cycle when a firm starts to stall out on its growth and its innovation starts to turn sideways. I don't think that's the case here in prop tech. So what's the difference and what, from your perspective, is going to be driving some of that consolidation?
Yeah, so I think you're going to see a lot of, first of all, if at the end of the day, if you dig deeply into what's going on in these larger organizations, in my mind, in these white collar jobs, it's a lot about people, right? And we're coming off several years of just an impossible recruiting and retention market. And some folks are still obviously figuring out what does back to work mean and how do we keep our folks and how do we treat people in this environment. For example, we went deliberately entirely remote first August 2020. It's one of the hardest things I've ever had to do, as someone who grew up in an office environment. I can only imagine what Jamie Dimon and everyone else who runs huge organizations is going through around this. So there's been a real kind of unsettling situation here. It comes back to people. At the end of the day, in the long run, Scott, this is going to be about recruiting and retaining people. And you can't recruit and retain people organically fast enough, generally, with tech, digitally native or tech orientation from the ground up by building it yourself. So I think you're going to see as these early stage companies become mid-stage companies and they have to figure out how to raise more capital in a tougher environment, they're going to be much more open to conversations at reasonable exit valuations, and so will their investors. And I think a lot of these enterprises who have been bit by the bug are in on the joke, whatever cliche you want to use, are going to see opportunities to scoop up teams and organizations and future leaders at reasonable prices from their very strong current balance sheets. And that's one of the key things right now is most of the large organizations are playing with record high or near record high balance sheets, cash and cash equivalents from what we've seen. So it's a good time to go shopping while there's this kind of volatile market in the innovation world.
Yep, I got you. From my perspective, and maybe it's misplaced, but you can correct me, but it seems like startups are classified as startups with more advanced, proven out technologies or concepts with more funding, and early stage funding rounds have been getting larger in size. Is that the case? And if so, what's really driving that?
Yeah. So first of all, there was no later stage funding because there was no innovation happening in this. There wasn't even a category several years ago when, you and I started thinking about this space. In 2024, something like 72% was seed funding. In 2020, it was 36%. So by my math, that's half, right? So there's a lot more later stage coming in, or, seed, early, late, right? That early and late stage is starting to become a much bigger percentage. You're also seeing funding rounds over $10 million, be almost half of the market. So, institutional capital comes into these investment managers like us, larger fund sizes, larger check sizes, big dog, big food bowl. So you got to deploy larger dollars. Obviously, nobody wants to do small deals. The law of large numbers is one of the fundamental principles I'm sure everybody learned in their finance class at NYU. The idea here is more money's coming in. You got to write bigger checks, and so in the boom times, entrepreneurs are taking as much as they can because they're coached to do so, and venture capitalists are incented to write larger and larger checks into them. I don't think we've gone way out of whack on this. I think this was a pretty natural evolution, right? It's a sign of a healthy market that we're not only doing seed deals anymore, but that there's, graduation, if you will, into the later stages. But the facts are pretty clear that larger checks have been a bigger part, and that's a testament to the success of the category.
Yep. And I think also there's probably an evolution of, I'll call it knowledge from those who've gone before them. And I think founders today probably know more than founders in the prop tech space 5 years ago, right? And there's more talent in the sector. And so they're able to accelerate the early stages of their development before they start, the bigger rounds of capital raise, right?
Yeah, totally. I mean, we're seeing folks who have raised 500 million in equity. There's a category we're tracking 200 to 500. There's a category we're tracking 100, to 200, 50 to 100, and 25 to 50, right? And those are all, that's a pyramid, if you will, of opportunities. These folks are all learning from each other. And one of the fun parts I don't know if this gets out there very much, Scott, but we're able to back not only folks who are leaving prop tech companies and starting new prop tech companies, we're being able to back founders of prop tech companies going to start new prop tech companies, right? And so the ecosystem continues
to change over at the top.
Yeah. That's really exciting. Used to have to be, we would have to find a tech person and a real estate person and, fuse them, like some sort of nuclear experiment into a prop tech person. Now we're getting, native prop tech people coming for round 2, or in some cases, even round 3. Pretty fun.
Are you seeing, well, let me rephrase that. How do you, you mentioned there's probably 7,000 startups there. Gosh knows how many you guys are seeing and how you're weeding through them. What are some key attributes that you're looking for? Is it just a really catchy idea? Is it a better mousetrap? Is it the right founder? Is it all of the above, none of the above?
Yeah. Yeah. So we're seed investors. Again, we do one thing, tip of the spear. I mean, we have a later stage pool of capital, but it's a best ideas fund. But really, when you think about who MetaProp is, we do tomorrow's technologies. And when you're focused on tomorrow's technologies, you're going to the riskiest corner of the universe. You're going into things that don't necessarily have a fully developed team. Certainly, in most cases, don't have a fully developed product, and in no cases have a fully developed P&L, right? Maybe not even any revenue. So it could be pre-product, pre-revenue. And in those cases, there's only one thing you can bank on, that's team. So this is, we write a little bit about this in Prop Tech 101, our book, right? It's like, it's team, and maybe the size of the problem that they're solving, right? But mostly it's about backing the right folks, because this entrepreneurial journey has peaks and valleys and meanders along a very long life cycle, and it's really the resiliency and capability of the founding team that generally is the biggest indicator of success. Beyond that, of course, having some technology is important, but what the product and technology is at the time we invest and what the product and technology is at the time the IPO are vastly different.
Quite different, right? Yep. Can we get in the weeds a little bit on opportunities in different property sectors? I think work from home, obviously I'm getting tired of that phrase, but is the office space changing? Is there office tech? Is there residential space opportunities? Let's get in some of the weeds on some of the property verticals and where you're seeing tech emerging there.
Yeah, so I can give you some examples out of our third fund, which is the one we're just finishing investing out of now. We've done technologies around construction and development across all asset types, continues to be really interesting. About a third of our investing over the last 5 years has been construction and development related, whether it's computer vision or laser scanning translated into digital BIM, or workforce selection and empowerment software. It runs the whole gamut. That continues to be a really interesting space, and there's going to be a lot more. Procore's success and Autodesk's continued dominance and acquisition appetite bode well, I think, for this category. One area that hasn't been as much evaluated has been the international markets. So that's a trend you're going to continue to see going forward here, mostly on the residential side. Scott, I think you're going to see the trends that we saw here 3-4 years ago. The Open Doors of the world, as a great example, continuing to be interesting plays in large markets, both mature and emerging around the world. So we're playing a little bit in there. Some of our peers are playing heavily in there. Office is tough right now. Tenant communication, you just saw a big announcement from our portfolio company HQO and their big deal with Related. That's technology that we invested in years ago, right? So you're hearing news about things that were cutting edge years and years ago on the office side. Office is tough. Everybody's struggling a lot right now. Everybody wanted it to be access control and HVAC, COVID related quality of life, health and safety stuff, and a lot of those are really tricky because they all have some sort of hardware component in most cases. So office tech is not certainly pencils down for us, but it's a tough time to be piloting and testing when people are trying to figure out what their asset type looks like. I think there's some really exciting stuff happening in the warehouse space and supply chain space that wasn't happening previously. Movement of goods and services, and the if you listen to Prologis executives, the kind of operationalization of that asset type and the services around the rectangle of the box that is the shed the business is being done in is interesting. Hospitality tech kind of cooled off quite a bit over the last couple of years. We didn't see a whole lot of innovation. I expect that to hotel tech. And a lot of that's coming from, the hospitality and residential convergence. We did see a lot on the multifamily side, a lot of new business models, leasing up new developments through technology, again, tenant and occupier communication technology, operational focused technologies that are, improving ROI through NOI improvements at the base building level, at the asset level. I think you're going to continue to see a lot of that stuff. Some stuff I don't think you're going to see a lot more new innovation of over the next several months is, kind of AR, VR type of virtual tours, at least side. I think if Apple comes out with some really groundbreaking stuff, we could have another turn on that. I'd be very skeptical of tokenized real estate still. I think we're going to see a lot more tokenization in our day-to-day lives outside of real estate before it comes into real estate in a meaningful way. I think there's another turn there. Blockchain, I think this may be the cycle here. We were risk off from investing in most blockchain related technologies. In retrospect, I'm extraordinarily happy. Given our time horizon, we would have gone up and then straight back down in most cases. So feeling pretty good about that, but this could be the time. This could be the cycle here over the next 2 or 3 years, and we're looking heavily at several companies that are building, kind of Web 2 with an eye on Web 3 from an infrastructure perspective. I think parking will continue to be an interesting place, but not a ton of investable innovation. But I think that with the electrification and the autonomous driving capabilities that are continued to develop here, particularly with everybody's focus on ESG. And if you read Bill Gates, it's the electrification of everything we do that's going to drive that. I think parking is going to be even more interesting from a technology perspective. Those are just a few tidbits of areas that we find interesting. Yeah.
Okay, no, that's cool. Look, you mentioned warehouse supply chain. You just mentioned parking. I know, if we go back to the early days, there was folks who were talking about muni tech or urban tech. I don't think they talk about that anymore. But is there more of a focus? Do you see a little bit of an expansion of what you're looking at, things that are more traditional infrastructure or sustainable infrastructure, particularly as it pertains to ESG? It's kind of out of the realm of what would be previously considered prop tech.
I got to tell you, I'm not advertising a focus on real asset ESG prop tech related investing, right? The reality is a lot of technologies that have application from prop tech into ESG are equally applicable or somewhat applicable to other real asset categories like infrastructure. I would just, if it can work on a facade, if we've got a company called Aaron that's related to the university, I believe, that's scanning facades for structural damage using computer vision and algorithms later upon it to help identify, instead of doing a visual scan, the computer will tell you when there's issues coming up, right? That works on the facade of a skyscraper. It also works on a bridge. It also works on many other real asset types. So there's that kind of, it was purpose built for one or the other and has blending application. We are not expanding our scope at the moment into energy or some of the other infrastructure and real asset categories, but we continue to play a lot there because the technologies we have application, or things are coming over the transom as they're trying to blend and find new client groups and customer groups.
Yep, makes sense. Look, shifting gears a little bit, obviously inflation's on everybody's mind. Public REITs, public companies in general, big private property owners, I think they're all looking to integrate more tech to kind of reduce operating expenses, reduce some of that friction. Should we be viewing tech as a hedge against inflation, or is because it's more highly adopted during an inflationary stagflation time, or is it kind of separate from that?
I used to say, Scott, I used to be like Debbie Downer, running around New York City talking to all of our big partners from all the big name shops and kind of winking at folks and saying the real wave of innovation and adoption is going to come in the downturn, right? I think fortunately a lot of the wave started before the downturn and before the inflationary environment. Folks got the joke a little sooner relative to that cycle, and it took longer than I thought, but inflation took longer than I thought too. So, without a question, margin expansion is what the REITs talk about. Price per share is going to be back to focusing on net income and, kind of core fundamentals. Therefore, anything that can drive new revenue or squeeze out costs is going to be hot. And it's not really easy for larger organizations to do either of those things. Where that happens is at the tip of the spear of innovation. So I think it bodes very well for us. Yes, this stagflation, high inflation environment of real estate organizations thinking about that new revenue stream and or that cost saving opportunity in an even more significant way.
Yep, gotcha. Maybe as an interesting segue to introducing one of our students to throw some questions out there from the student's perspective. I know a lot of VCs over the years have started incubation strategies, looking at supporting, I'll call them, pre-startup groups. You guys, MetaProp has done an interesting twist on that, I think, by partnering with universities. Should academia play a larger role between prop tech idea generation, incubation, adoption? How do you kind of see academia fitting in to your strategy?
Yeah, it's really cool. Again, there was nothing, and even real estate programs, right, Scott, are still relatively new, right, in the academic world. So therefore, prop tech isn't going to be as hot. I think Zach Aarons was one of the first prop tech professors. My partner and co-founder, we were talking about him earlier. He's the top investor in the space. Who wouldn't want? And he's hysterical. Who wouldn't want to hear him talk? He also wrote a book on the category. That book that we wrote is now being taught, I think, in 10 plus universities, right? So the fact that this is starting to work its way into the thinking of the traditional real estate educators and researchers, as well as the student body, is nice and warming. And my grandmother's very proud. The fact that there are prop tech professors and prop tech related professors in various markets around the world, I think, is really interesting. I think I haven't seen a ton of tech transfer office interest in the prop tech space yet. Folks are still focused on some of the other categories, including biotech and healthcare in some areas where it's more, the path has been plowed more cleanly. But I think you'll see that, but that's probably more of a 10-year play. I do think what we've done with Columbia, the startup accelerator, Columbia University, was pretty innovative and early. I think you've seen Oxford do a little bit of interesting stuff around it. I think if the US doesn't get its act together around incubation and acceleration with a focus on this category, you're going to see some of these faster moving markets, particularly in Asia, start to leapfrog us, and some of those universities, grab the mantle and diminish some of the strength that we as a country, in particular, we as a city, have built up, right? New York is still in many ways, I would argue, the capital of prop tech globally. So I would encourage, pace to even get involved in the prop tech. NYU and Columbia need to lead the charge, really.
Yeah, well, I appreciate hearing your thoughts. And I know Professor Tim Savage has been a big champion of data and data collection and data transparency. And for him, that's been one of the linchpins of really getting, prop tech to really accelerate when we get more of that data transparency. So something that we're focusing on more here as well. Look, one of the phenomenal things about my role here sitting at the REIT Center, being able to interview folks like you is being able to integrate some of our students into these conversations. So I'm going to introduce you to Jacob Bernstein. He's one of the undergrads in our program. We've got about 750 matriculated students. Jacob's been very interested in working with me and others on inflation and technology. And he's got a few questions he would love to pose to you from the student perspective. Jacob?
Thanks, Professor Robinson, and nice to meet you, Aaron. Thanks for coming to speak.
Hey, Jacob.
So I guess I'll just dive right in. You mentioned how blockchain is going to be big in this next prop tech investing cycle in the near future. So one thing I've been wondering is, I know about the great potential for, impenetrable record keeping and securing transactions with blockchain and Web3 technology. But I'm wondering, is there anything to be wary of as Web3 is implemented into prop tech and the greater real estate world in general? Or is this kind of just the tech we need and it's going to solve a lot of problems?
Yeah, it's a great question. It's the underlying infrastructure of everything technology in in some future wave, whether it wasn't in this wave, it may not be in the next wave, but I do think some interesting businesses will be built here that will catalyze this transformation. It's just one man's opinion. So, I think you need to be watchful and cautious and deliberate, which sounds ridiculous as an early stage, seed investor, right? Those aren't words that you would normally associate with my thinking. Probably more like reckless, we do have fun with our investments. I think you got to be careful because there's going to be a lot of pretenders. There's going to be a lot of noise. There's going to be a lot of hype. There's going to be a lot of Ponzi scheme looking concepts out there. We've all seen it, we've lived it. Probably more students, wealthier students than I am here from having played some of these NFT and crypto markets. There's going to be things stolen, right? There's going to be huge, scary, hairy opportunities and problems in this space still. And I think to ignore it is at your own peril. Here, to embrace it wholeheartedly at the exclusion of doing business in a Web 2.0 way is probably equally as foolhardy at this moment. I think, figuring out the best way to solve the problem with the shortest distance between 2 points is the right move now, with an eye on how things are going to continue to be built in the future, is the way I would suggest that folks think about this right now if they're looking at new technology and new businesses. Definitely,
yeah. But it's interesting to hear a little bit about how what to be aware of, because all kind of I hear about is it's going to be great, changing the game. So it's an interesting way to look at it. Next question I had was, so from my little experience working in brokerage, I kind of my understanding of how real estate is traded based on you underwrite certain return metrics and what's the cap rates are the big questions investors are asking. But as big data starts to play a bigger role and real estate companies have more access to it, how do you think having this sort of transactional data, market data, all these, tons and tons of data points are going to change the real estate investing landscape?
Yeah, it's already started to change the investing landscape. The reality is nobody's doing data at such a level yet that it's entirely transformational. There's a good, I forgot her name. There's a great TED talk that I've sent to a lot of people. I'll find it and send it to you, Scott. But the concept is gut data gut, right? So real estate used to be, if there's a McDonald's across the street, I'm going to go to. If there's a Starbucks across the street, from a retail perspective, I'm going to go there, right? A broker was kind of just a Neanderthal who's earning a fee. Right now, with companies like our portfolio company, Locate AI, you're able to plug in historical sales data overlaid with tremendous, huge outside data sets and come up with predictive analytics around same store sales at various specific locations, in a 3-mile radius, for example. You're still not going to make a decision on that, right? We're still not quite yet at the point where the data is making all the decisions. At that particular use case, there's still the gut, then the data, but then ultimately the gut decision will be made. I think that's going to be around for a long time, Jacob, is what I'm trying to say. I think the human element and the judgment and the risk assessment is going to be really important. There isn't this imminent, that I see, immediate, universal, ubiquitous data existence, digestibility, and actionability out there. We're still several kind of steps away from that. Some large enterprises don't even understand what a data lake is, right? Never heard of SQL. I mean, we're still kind of back to basics in many ways here on this space. So I don't think anybody needs to worry too much about it. The biggest organizations are just starting to get their arms around some aspects of their own internal data, and now starting to look outside. What new data sets can we bring in, and how do we bring them in a smart way? A lot of window dressing around that, frankly, from what I've seen, a lot of BS of, we're going to make tech-driven investments. There are folks making, newer companies coming up who are very agile and refining their technologies quickly, doing more tech-enabled investments. The single-family residential space, if you look at what, the early folks like Invitation Homes and others were doing around tech and data. That's certainly changed the way we buy, but still in many cases, there are human beings involved, and there probably will be for quite a while. So I would say I don't bet on this enormous amount of data being perfect, digestible in a beautiful BI tool that you can, just set on autopilot. That we're not going to be the commercial aircraft industry here, maybe for a couple more cycles.
Gotcha. Okay, and then final question I have is, so what kind of, I guess throughout the companies in your portfolio, or just that you've seen do well in prop tech, what aspect of the real estate investing cycle do you see the greatest opportunity for prop tech innovation, whether it be financing, deal sourcing, underwriting? What is going to be, maybe, I don't know about automated, but the most changed in somewhere down the line by prop tech?
Pop quiz. How many traders are there on the trading floor at Goldman Sachs today? Well, let's talk about it this way, Scott. When you and I graduated from undergrad, how many people went out and became traders?
A lot.
A lot, right? Today, people are going out and putting on the jacket and going on the trading floor, right? I mean, you could call those folks traders, brokers, right? The financial service industry is a good look, Jacob, at the future of this organization, this industry. I think it's hard to believe that brokerage in its current iteration will continue for more than another cycle here. Something fundamentally is going to change. You're already seeing everything that was pen and paper moving, business process automation, right, digitization. But I think there's going to be interesting new businesses that we haven't even seen yet created that may disrupt that. It's just my estimate. On that side, that's low hanging fruit. That's an easy thing to pick on because everybody sees that and everybody hates brokers. As a former broker, I can speak on that. One area I'd like to see, if you're asking Aaron Block, one man's opinion, the senior housing space. I think one thing I would have expected coming through and out of COVID is that, independent, assisted living, skilled nursing, hospital, rehab facilities would have had a much bigger innovation push through prop tech than we have seen. It's been tough. It's obviously a very fragmented in this portion of the industry. Cold storage, I think, is more institutionalized in that world potentially, right? I mean, so there's still some room to go and there's some reasons why, but that's an area I would have thought, and that would really make a difference for humanity, right? Having some real estate related technologies, but anything that's, operationally heavy, that, if you look at hospitality, right? Hotels. But again, as I said before, one of the interesting things that I've learned, and I didn't know this coming in to this prop tech space, is that the blending of all these asset types into everything is hospitality, everything is service oriented, means that tech will be much more important and interesting. Those are two areas though that I think, I'd like to see more transformation a little sooner in.
Awesome.
So on that brokerage side, is that where you see the blockchain opportunities coming in?
I think blockchain will be the underlying technology. I don't think blockchain is a solution, right? I think blockchain, it's essentially the ones and zeros infrastructure of whatever the solution will be, and it will make it, a better solution, but it's not going to be a solution. So, when someone says I've got a blockchain, I don't care, right? I want to know the problem that you're solving. I don't care what your technology is built on, at least in the first conversations. I want to really know, what is the problem we're solving and how are we solving it? Technology doesn't solve business problems. Business solutions solve business problems. Technology very frequently can make it, bigger, better, faster, stronger.
Well, Aaron, I know you're very busy wading through new opportunities. Maybe parting thoughts, any guidance for our students on what they should be focusing on in the real estate program? Should they be more quant? Should they think more asset management, thinking about how business can be done better? Any thoughts there?
I mean, I got to tell you, if I could rewind the clock, I can only share my own experience on this. I don't like to give advice. I can tell you what's coming up for me as you say that is I went to the University of Illinois, one of the top engineering schools in the world, and I didn't take a single computer science class, and shame on me, right? I mean, literally shame on me. NYU has fabulous opportunities there. You get electives, choose them wisely. Real estate's great, and a lot of you come from real estate related backgrounds or families, that wonderful. You can always get more real estate, but getting some of the foundations of object-oriented design and some of the other concepts that can underpin the future of your career, I think is incredible opportunity when looking at my own career. I feel like it's a handicap almost, and I'm a Gen Xer, right? So if it's a handicap for me, I can't imagine what it's going to be for everybody in the incoming cohorts.
Fair enough.
Schack is adding a couple, I think, data visualization, data analytics. So definitely taking those to get that knowledge.
Good. All right, Aaron, wonderful conversation. Appreciate your time. Look forward to continuing this in the future.
Yeah, and happy to have anybody over to PropTech Place on 39th Street to see and hear and do more.
We'll take you up on that.
Thank you, Aaron. Great to meet you. Thank you, Professor Robinson, for having me.
Thanks, Jacob. Appreciate it. Nice job.